I'm here with Jim Chronis, Chief Economist and Portfolio Manager at Ausbil Investment Management. Jim, thank you very much for participating in the Investment Leaders Forum New Zealand.
Thank you for inviting me, and thank you to be here with you.
It's been a great pleasure to have you, Jim. Now, your contribution this week has been on the macro-driven frameworks that help inform your investment approach. Can you summarise for us in this interview what that looks like?
Events that just happened on Friday to Tuesday is relevant to the process. New data comes in. The process has settled on a macroeconomic view with a set of assumptions and forecasts. Those forecasts are then given to the sector analysts, who then use them as guideposts, who then also apply it to their stock selection. That's the process, and the process is constantly reviewed. The events of last week represented financial and geopolitics. So the first one was a news article that indicated that Warren Buffett had reduced his holdings in Apple by 50%. The second was the announcement of non-farm payrolls coming in lower than what the market was expecting, but it was still positive. And the fact that the unemployment rate jumped from 4.1 to 4.3, you're probably saying, what does that mean? From the low that we established a year ago to 4.3, it triggered a market took it as a view that it triggered a recessionary indicator, not imminent, but on the horizon. So they then sold. They had an impact on equity valuations, so that had a ripple effect. Prior to that, you had the Bank of Japan hike rates by 15 basis points to 25 basis points. They had been negative for over 2 decades. And they also announced that their holdings of Japanese bonds, which are sizable, they're going to be tapering them at 400 billion yen per quarter to the end of March 2026. So it has an impact on the bond yield, especially on the Japanese 10-year. So you had that announcement. Market reacted. I believe that the market is now more driven by algorithms rather than a human intervention. It compounded. They call it the unwind of the yen carry trade, where you borrow in yen because it's been so cheap. You're unhedged. That money leaves Japan, goes into the rest of the world. There may be leverage on the back of that, and it goes into assets. And so there's a repricing of those value of those assets. So people had a margin call. It was instantaneous. It was conducted over, I would say, 48 hours. There was a flight to quality to bonds. Then adding to the perplexity of the environment that we're in, the uncertainty, was the fact that relationships between Iran and Israel have deteriorated. Iran has indicated that they will retaliate in some form against Israel for the death of the Hamas leader in Tehran. So that's fear number one. Fear number two was the Americans announcing on the weekend they were deploying a carrier group into the Gulf. So you have geopolitical risk on top of the perfect financial storm, and we're in the month of August, where trading volumes are quite low. Had an instantaneous reaction on the markets, and on Tuesday when I was explaining to the team on the investment process, we relayed our current thinking and came to the conclusion we're on track. But then the discussion moved into a crisis, and how does a crisis evolve into a recession? And the parallel here I gave in 1997, where you had the Asian financial crisis, which led to a financial instability or financial stability issue, leading to LTCM and the Federal Reserve having then to embark on emergency cuts. So that was the closest parallel in life, but we're anywhere along that time frame as we speak. And the indicator there would be the performance of the US 10-year. If the 10-year started to go up, it meant that we're through the initial stages of this washout that we experienced. And that's the process.
Given your focus on macroeconomic analysis as the first stage of your investment process, how do you assess the current economic conditions and their impact on sectoral attractiveness?
Okay, very good question. So you can't interpret macroeconomic data in a vacuum. You need a reference point, and that could be cyclical or structural in nature. So my backdrop is that we're in an environment where the world is actually doing better than what we had experienced in the last 2 or 3 years. So you interpret monetary and fiscal policy actions against that backdrop. That backdrop signaled to me that the US is resilient, that you will have a broadening in global growth, that you can achieve full employment levels, and that interest rates will be eased moderately, and more importantly, central banks will get inflation back down to their target levels that they'll be aiming for, which is a positive environment to which it supports equities. And at the margin, with bond yields where they are now with 4% in front of them, bond yields become an attractive investment asset class as well.
You mentioned that earnings revisions and ESG factors are crucial in your stock selection process. How does integrating ESG considerations enhance your investment decisions and contribute perhaps to help you identify early stage earnings trends?
Okay, let me repeat the investment process that we have at Ausbil. We have a 4-stage process. Stage 1 is macroeconomics. Stage 2 is sector. Stage 3 is stock selection. And stage 4 is portfolio construction. Those first 2 stages, 1 and 2, in terms of attribution, should give you 25 to 30% of the alpha. The remaining balance comes from stock selection. At stock selection, we use ESG, a proprietary model where we talk to management, we have a number of factors, and we rank those companies from a score of -3 to +3 in terms of our conviction on quality of management, quality of earnings, potential issues on the horizon that could affect their earnings. And we engage with management. At the stock selection level, we engage in the year close to about 1,600 meetings with companies that we invest in. So the ESG gives you a mark on the quality and the sustainability of those earnings for a company in that sector. The analyst takes that on board. The analyst takes on board the macroeconomic forecast we have in place, and then from their bottom-up research, makes a call within that sector on the various companies that are in that industry. That's how it works.
With expectations, Jim, of modest rate cuts and improved inflation trends by late 2024, how are you positioning your portfolio to take advantage of these anticipated economic shifts, particularly in the sectors that you think will outperform?
So we see growth, we see inflation heading lower, and we see modest interest rate cuts in a real sense, not because the economies are slowing, but because the real interest rate's too high. In that environment, you're looking at an environment where earnings will be positive, nothing too flash. We're looking at 5.3, the market's at 3. And within that, at the sector level, we've identified key structural themes that we're overweighting and where the earnings are better than consensus. That's where we will allocate the portfolio to. And those other sectors where the earnings are going to be less than what we expect, then also they're not as attractive for the 12 months ahead, we're underweight those sectors.
Across this wonderful event, Jim, we've heard so many views on markets, but also on framing the themes that are being discussed for advised clients. What have been some of your key takeaways from the Investment Leaders Forum New Zealand?
There's a difference in it provides a different perspective of how information is provided, how it's assessed, and how it's implemented. And what I mean by that is you have views from asset allocators. In this forum, you find that where their priorities rank in terms of achieving stated returns. You do not get that degree of transparency when you are just offering your product, which is a core equity product, and trying to see where that fits within their overall framework and their objectives. You have a different perspective of what their priorities are. I think that's the primary take so far from this conference here in New Zealand.
Jim Chronis, thank you very much for participating in the Investment Leaders Forum New Zealand.
Thank you very much, and thank you for having me here.